Hello and welcome to Avanade Energy Series. Today in the studio, I've got Chris Regan, the Managing Director of Brady Solutions. Chris, who are you? And tell us a little bit about your background.
Of course. So at the moment, my role at Brady Technologies is as Managing Director of Short-Term Trading, so short-term power, I should say. That means that I look after a number of products from data managers that look after our customers' data solutions to schedulers that allow customers to schedule power across 30 plus countries across Europe. But also I look after our flagship short-term power trading product, which is called PowerDesk, and its algorithmic solution, Edge. On the side of that as well, I've created my own energy consultancy because I have a background in batteries. An energy trading advisory, of which I'm the founder of, advises various battery companies on their RFPs, but I also work with a number of consultancies and equity firms looking at M&A, etc.
Great, and prior to that, do you have a number of years of experience in trading?
Oh, many years in energy. I actually started off in the nuclear physics side of what was then British Energy, and that moved to be bought by EDF. And from there, I moved into power trading when the market as we know it opened up. So new electricity trading began, I think it was 27th of March 2001. I was a shift trader on the desk there, and from there I kind of moved up to managing the trading team. So I also saw a market opening in Ontario, which was quite exciting as well. And I moved from asset optimization into managing all of the trading desks. And when I realized my amazing knowledge of coal and gas power stations was going to be redundant, I moved into our innovation lab, created a battery trading business for EDF called PowerShift, and then I moved on to product management at Brady Technologies.
Great, so you've done all the roles. You've been a nuclear physicist, you've done trading, you've been the head of trading, you have been a product developer, and you're doing consulting.
Yeah.
Wow, what do you enjoy the most?
Trading gave very, very good kind of feedback immediately, so you would end your day feeling very good or not so good. Then moving into trading management, it was more of a, how do I make sure I understand where the value is? Traders always make a profit if you allow them to tell you how they've done. But actually creation of products, being PowerShift in EDF for the battery business or PowerDesk in Brady Technologies, probably the most rewarding because you've created something. And you know, PowerShift in EDF has gone on beyond me and is one of the biggest optimizers out there of batteries.
Great. Well, we're really excited, Chris, to have a long-timer power trading specialist like yourself in the room with us today. And we'd like to pick your brain, given your knowledge in this business area, for the evolution that you've foreseen, right? So back in the day, the grid was very much coal, gas-fired power stations, a lot of predictability with these big assets, to a grid now that is in the influx of large renewable assets with lots of batteries, smaller assets. What does this transition mean from an evolution of a trading perspective? What are the risks and the opportunities that lie with that?
Well, when I think about the transition of the generation mix and the decarbonisation of the country, it correlates very well with the type of people I used to employ as traders and how it evolved from the early 2000s to almost like 2015, 2016. And in the very early days of the GB short-term trading market, I would employ people with really, really strong communication skills because I felt a trading desk to make profit had to be quite self-portfolio orientated. So was my power station going to raise load, drop in load? What were the risks around it? So they very much had to have amazing communication skills and they had to think about insight a bit from the market. Then those people would also be very good at talking to power station operators. Now, but as it evolved, as I got through probably about 2014, when I really saw the transition to a lot more wind. And as you saw the renewables being there, they had to move to being insight and much more numerical based. So I previously would have probably recruited someone with maybe an engineering background, but I've had musicians, etc., really good communicators, and I started needing more and more to recruit someone with either a maths or a science background, less so engineering, very much less so on the economist side, and they really had to have ability to take in big data, look at like an LCP or an Synapsis screen of all of the things that are going on the market. And they stopped looking at their own portfolio and they had to be much more market facing, because intermittency in the form of wind and solar was coming in and moving the country's position around rather than your own. And the risk then moved from a volumetric risk, because you're trading your own book, to a price risk, because prices got more volatile. So you might have a smaller position, but it moves around in price a lot more.
Brilliant. Well, that's quite the transition, right? And the transition as it's emerging now is we've got 4.4 gigawatts of battery on the grid today, and we've got about 4.2 under construction, and another 14 gigawatt anticipated to come online by 2027. Yeah. And what is the opportunity with batteries? Why is everyone racing to bring more batteries on the grid? Is there a role for batteries and decarbonization?
Well, I think I'd give a very different answer about a year ago, before we saw a sudden fall off in value. So we saw batteries suddenly starting to make decent money in late 2020, like kind of the post-COVID era, and it was difficult to balance the system. But the best year by far for batteries was 2022. And as we went through the kind of invasion of Ukraine and the gas worries, it was very expensive to run combined cycle gas turbines. They came off, it created an inertia problem, and therefore the value of products, which synthetic inertia means batteries moving around in a way that replicates spinning turbines. Dynamic containment, dynamic regulation went up so much in price, you were making huge amounts of money in batteries. However, as we went through 23 towards the end, we saw a fall off in value. And with a mild winter in 2024 at the end in February, huge plummet. So I'm seeing a lot of those projects stalling. People worried about the investment on them. But my view on batteries is they're going to kind of bounce back. They're still there to help with inertia. So inertia is the spinning momentum on the system, but they're probably going to make much more money out of handling intermittency, just charging and discharging, inversely correlated to the wind and the solar to make up the difference.
So for a trading company, what are the opportunities with batteries coming on the grid? What are the sort of revenue streams they should be going after?
Well, my view when I created the battery business in EDF was you have to be capable of doing every revenue stream that might come, as well as ones that are there, because revenue pushes and pulls between the different streams. Now, your longer term investment is going to be underpinned by a capacity market contract. You're going to want to ensure that if you're going for a new build, you get a good price for the 15 years. But you want to get that income stream. That might only be circa £10 a kilowatt annualized value into your book, but it's a long-term value. Then you're going to be looking at getting your revenue stream through the ancillary services out there. So at the moment, you've got dynamic containment, dynamic regulation. They're all pinned with the other ones. They're called the D-star services. These are the ones that are most likely to saturate. They're there to take account that spinning turbines are coming off the system and they're being displaced by wind and solar, which are non-synchronous with the grid. Those generally plummet when they're oversupplied, because at the point that there's too much in the system, there's nowhere else for those services to go, so naturally the price falls down. However, the wholesale market, which is much deeper, is the kind of final revenue stream. Wholesale market is generally with a battery traded a day ahead with the right price granularity. It moves into intraday volatility trading, so the wind forecast moves, one price goes up, one price goes down, you move the arbitrage of the battery, and then you've got the variant of whether you take it into a NIV chasing, which is basically betting against the direction of the system, and you could get lucrative cash out prices. You can do that for now. You have to be under 50 megawatts, you have to be non-BM, and it's been made clear by National Grid that if you try becoming a BM unit and moving back, you're not allowed to. So that's finite. So you can then relying on National Grid through the balancing mechanism, which is where you get moved up and down by National Grid to meet the very short-term demand in the last half hour. You give Grid those prices, they move you around, and Grid's got a lot better at moving small batteries around, so you can start making money out of there. So as long as you've got that diverse stream, then you're going to make money, whether suddenly ancillaries have got value and there's no value in volatility, or it will shift. And then the coming markets are going to be the kind of distribution system markets. Our local market's going to come to balance huge swings in EV charging. How do you monetize an embedded unit, which is in the smaller, lower voltage end, next to everyone plugging in their Teslas? That's going to be an interesting thing. But similar to that, there's a big risk coming as well, because I don't think the market is always very well thought out in changes. You have modifications like P462, which is a way of stopping renewables being paid not to generate by allowing their subsidy to continue when they turn down because there's too much electricity. That's one of the biggest risks for batteries at the moment, because batteries make money over the difference between high prices and low prices. And if you stop wind generation putting negative prices in to turn down to cover the subsidy, it's going to be a huge hit in the value stream of batteries. And I think a lot of developers are looking at that one thinking, do I develop now or wait to see where that one's going?
Chris, I love how you remember your change process numbers from the balancing settlement code there, right?
I know the odd one.
Yeah, great stuff. So with the amount of data that is now needing to be consumed for the multi-market optimizations that the traders have to go after, it is a huge data problem to solve, isn't it? And not only data skills are important, but data capabilities and data platforms are becoming more and more important for trading businesses.
So I think what it all comes down to is the mindset of the trader in 2001 when the market opened. They looked at maybe 10 assets. You can hold 10 assets kind of schedules in your mind, and they knew what they cost to turn on and off. And so you have to sit there and remember 10 numbers. It wasn't the hardest job in the world. When you replace it with a fleet of, say, 30 batteries, and you've still got some gas and some coal assets, you can't expect someone to remember 48 half hours times, say, 30 assets. You get a big data problem. So at that point, you have to think about your portfolio in a different way, and you think about your software in a different way. The first thing I think about the portfolio is you've got to stop trading by megawatts and start trading by price. What I mean by that is a shift trader, short term, historically, would see an asset move or would want to move an asset on the strike, and they would trade out their megawatts at the market price. However, once you've got many, many assets, you need to rotate your mindset by 90 degrees and start thinking, how many megawatts have I got at this market price? And then you have an optimizer in the background, which based on a market price tells you whether you're long and short, so whether you buy or sell, and then you need the visualization of that. And that's where I've created a trader's platform in PowerDesk at Brady, which is a completely different way of looking at your portfolio and your position, so that you can have 100 virtual assets or 2 big assets, but still trade in the same way, reacting to the market movements rather than your portfolio movements.
Brilliant. And you sort of touched on the virtual power plants in essence, right? And we're seeing the prosumers, the C&I customers on their journey to decarbonizations have now got solar panels, they've got their air source heat pumps, now they've got their batteries, some have gone small, some have got big, but all of them combined together behind the meter start to provide flex. And as a trader, there are power purchase agreements, there are route to market services, there's your own portfolio. I mean, the amount of options out there are huge. You could be running nuclear for your baseload asset and have onshore, offshore wind, solar. We've talked about the flex assets, the hydro, the biofuels. I mean, how do you trade that sort of a portfolio? I mean, how many screens do you need today?
Well, I think you should only have 1 or 2, but you need to separate the megawatt from its source of generation and just see yourself as having a completely fungible portfolio of just pounds or euros if you trade in Europe and megawatts. The origin of the megawatt shouldn't matter anymore. It should just be an aggregated view which you can display to the trader whether I'm long or short, but also the optionality that if price moves up, how much more have I got to sell, how much more I've got to buy. You can no longer trade a portfolio of separate assets. You can only trade a total portfolio together and understand the position, the delta, but also the optionality of what's going on. And at that point, I think it gets easier for the trader, but at the same time, it's harder in the background. The software needs to aggregate up very efficiently, very quickly to give you a proper live position. In 2001, for example, when I opened a desk and the market started, I'd have a very old ETRM. All our trades would get captured.
And ETRM there being
so
energy.
It's an energy trading risk management. It captures your trades and tells you how much you've got in your position versus your generation. Now, that would spit a text file out every half hour to say this is your position. And in the interim, we'd kind of write down our trades next to the position, so the next half hour synchronized, we'd delete them. Now, that just wouldn't work today because traders could be doing hundreds of trades per half hour. You don't give them the world's fastest pen or a spreadsheet to do that. You need very quick capture, very live position reports, and that's a completely different data problem because originally ETRMs were built for people trading next year and the next year because it was all long-term hedging of assets like CCGTs, combined cycle gas turbines, that wanted to get budget secured to do maintenance programs. Now you're thinking about your half hour coming up. You don't know how many of your batteries are charging and discharging. You just throw a price into an optimizer and it's all done. So you can't wait half an hour for an update. It's a completely different kind of paradigm and clock speed.
Brilliant. And when we talk about an ETRM, that's one system in the trade life cycle of the ecosystem of other systems that need to be part of that same journey. Talk to us a little bit about what a good ETRM integrated end-to-end landscape could look like.
Well, I think the ETRM nowadays needs to be a lot lighter touch, but it needs to be segregated between long-term and short-term. So a long-term ETRM needs to be thinking about your risk. Okay, it's an energy trading risk management system. So therefore it should be doing calculations of your value at risk to understand that if market prices moved and I had this position, what's my risk, how quickly do I need to get out of it? So it still needs to be fast on market movements, but it doesn't really need to refresh its portfolio position. It then needs to interface to a short-term position manager. Short-term trading is very different from long-term trading. The simplest way to describe the difference is, today I could be trading winter 25, tomorrow I'll be trading winter 25, the next day I'll be trading winter 25. As I approach winter 25, I get huge loads of history, it's all the same instrument. However, if you move to a short-term trader, he'll start off, and what time have we got? He'll be trading something like period 26 at the moment, which is the half hours, and then he'll be trading period 27, and period 26 of that day will never exist again. So every instrument that they trade is non-rollable. It expires within probably the next 2 hours of liquidity. So suddenly everything they do is on correlations rather than history of fundamentals and technicals. And therefore they need to capture the trades in a different way. They need to look at positions in a different way. They need to react to the market very, very quickly in many, many instruments. So completely different roles. So as long as your ETRM long-term interfaces to your short-term power and you've got a good data manager, you're in a great place. But I think history has shown that if you try doing everything in one application, it doesn't work. So my real kind of difference I see over the last 20 years on trading desks are they don't mind segregating their tools to be appropriate for each job rather than a one-size-fits-all.
And spreadsheets are the common man's way of quickly getting an answer to a problem that can be solved in a system today. Yeah. There's been historically sprawls of spreadsheets because there's been a restriction to change within the ETRMs because of the lack of APIs and the likes. And do you see that being a problem in this day and age? Do you still see a sprawl of spreadsheets, and what's the best way of mitigating that? Because that does introduce an element of risk within the trading business, doesn't it?
Well, when the market went live in 2001, we realised our ETRM at EDF, or before that British Energy, was incapable of doing anything we want. I was involved in the writing of the spreadsheet that lasted over 20 years. I suspect elements of it might still be in use. People get very used to it because when there's a change, you can edit the spreadsheet very quickly, and as long as the person who wrote it doesn't leave without telling anyone how it works, you're okay, and most people can work out a spreadsheet anyway. The issue with spreadsheets is the change control, the lack of validation, and they don't interface to things really well. So the spreadsheet is the amazing UX interface. So in the products I've created, I've always looked to the way people use spreadsheets for data and how they've naturally evolved to see if I can replicate it. So I've recently been reworking an auction UI, and it very much feels a little bit like a spreadsheet at the start. You can kind of cut and paste in the same boxes, but it's got much stronger wrappers around it, around change control, looking for kind of tolerances on volumes, etc. So I think the look and feel of the spreadsheet interface could live on because it's a very good way of doing data, but in the background, it's going to be proper IT.
So when, I'm going to pick your brain a little bit further on your auction UI when you are thinking about going into an auction, what are the sort of things you're looking at to prepare for the auction? How do you work out the prices and things like that?
So you're generally, a typical trader going into the day ahead auction might have a generation forecast from intermittent assets, for example. And they might be thinking, okay, do I want to trade to the 50th percentile of my generation forecast? Actually, do I want to slightly bias it because I see the day ahead to within-day price movement as asymmetric? So if I think it's more likely prices will go up than will go down, I might trade to a lower percentile or take a position against it. So the first thing you need to do is to be able to vary the generation forecast you might trade against. And then you need to decide whether you want to go for a price-independent view, so I'll just take the auction price, or do I want to go price-dependent and tranche it? So you might say, well, if the auction clears really high, I might sell a bit more of my assets because they can switch on. Then what we've done is we've just created a visualization, which I call kind of like a colored topology of your auction bid to allow you to see what it looks like without having to look at 24, because it's hourly the auction, times maybe 10 wide bid pairs. Instead of looking at that kind of 240 pieces of text, we've created this coloured topology so you can see the shape of your portfolio and the shape of your prices. And we've done that specifically because it's very, very risky with finger trouble to put an extra zero in on one of those generation numbers, especially if you're doing a spreadsheet. So therefore that graphical interface and user experience of being able to graphically see big data in colours and bars is so much stronger than just text. So that's what our interface is really helping our kind of traders to do.
Brilliant. And Chris, I'd love to hear more from you, and we touched on this a little bit before when in your previous answer, the technical analysis and the fundamental analysis that traders have to do. Could you explain what the difference between these two different analysis types are, and how do traders prefer one over the other, or which one is more applicable to which kind of market?
So in the market, the two types of analysis, you said fundamentals and technicals. Fundamentals would involve a trader looking at all of the assets that can generate, determining what their likely cost to generate is, and comparing that to an overall market demand. And then that would derive what a fair market price is. And you do that for many half hours or hours out into the future, and you get this really good idea. Okay, well, if demand was seasonal norm, then you'd need these assets at these prices to come on. If it was slightly below in normal winter temperatures, it would go up. And you do it all on the fundamental prices of the market and assume people price quite logically. That does break down slightly when there's only a few people less with the margin, because at that point, you can charge more. And so it doesn't take into account human nature. Longer term traders have often like the technicals, and technicals are these shapes on market prices. So you see prices moving around and you basically it's extrapolation. And they say, oh, well, I recognize this shape. If the market goes like that, it regularly goes like this. It's used in crypto quite a lot, and you use price shape movements to recognize what it's going to do next. Now, technicals don't work in the short term because the products expire. So you can't track the price of an instrument for a long time because it doesn't exist for a long time. So instead you move to data science, and in the short term you would use data science to look at the correlations between instruments with similar instruments to see which way they'd move. So you might find that today's midday price has a relation to yesterday's midday price. Then you'd say, actually we're filming on a Monday, so Sunday is very different from Monday. So you might look back 7 days at midday. Then you say, but the weather was quite different then. So what you could look at is you could look at Mondays at midday for the last 7 years with seasonal adjustments, and you get an idea of what might happen. And that's the invent of data science for the kind of short-term power trading, which is very different from the fundamentals, which are still useful because you want to watch what the TSO is doing, but completely overtake technicals for short-term trading.
And we have to play into that every few years the regulation change, the market impacting forces change, for example, with the weather changing every 4 years in those cycles, right?
Yeah.
So you kind of have to validate but revalidate those assertions around data as well.
You do, and the biggest thing that destroys your data set is a regulatory change. So I remember I was doing lots of trading with my desks, and I was building my battery business in EDF when we went into single cash out. So GB specific used to have, in 2001, it was a dual cash out. So the cost of being out of balance in one direction was dependent on what grid did when they asked people to go up. And in the other direction, it was dependent on what grid asked when it went down. And then about 3 years later, they said, well, if you're out of balance in the opposite direction of the system, we'll give you a fair price of the market. And that was the reverse price. And at that point, all of your data on the way prices move was irrelevant because it was a completely different settlement if you were wrong. And then I think it was around 2016, we moved to a single cash out region whereby you had one price for being out of balance. And if you bet in the right direction, you can make quite a lot of money. So the way traders thought changed overnight when we went to single cash out. So what's the use of historical prices at that point? So when I was building the battery business, I didn't look back beyond single cash out. I said it was irrelevant. You know, you might as well look at what people were doing 10 years ago because the mindset of the trader changed overnight. And so that's gone in. If P462 comes through, which is this non-negative price, you're going to see completely different price shapes as well. That's going to destroy your history. And in the algorithmic trading solution I've built, we have a thing called a backtesting engine, which can give you as much history as you want and say, what would my algo have done in the history? You can only look back so far if they keep doing regulatory changes because it destroys the usefulness of your data set.
Brilliant. Well, this brings us nicely to the question I wanted to ask you, which is automated trading, or algo trading as it's called, Is it real? Are companies doing it? Or rather, I should ask, are companies doing it successfully?
Yeah, so it's interesting to start with your definitions, because you said automated trading or algo trading. My definition of automated trading is it's a series of IFTT, if this then that type rules that are put in to mechanically close out your position. And there's a number of products out there at the moment that just allow you to say, here's a line of 48 prices for the day, and if the price goes beyond this, trade it in a certain way. It's very mechanistic, but it's useful. It saves you the OPEX of running a trading desk, and generally it makes fair market value or slightly below it as they close out positions. So that's IFTT, or automated trading. What I've designed with Navish, my data science, I call it proper algorithmic trading, because it takes a view on whether you think the market's going up or down. And basically, prices can only do three things. They can go up, they can go down, they can stay the same. Yeah, they can get shapes in there, but it's not this super science that everyone worries about. You've got a position, I'm going to buy some power, I think market prices are going up, better buy it quickly. You know, yeah. I've got some power, I think market prices are going down and I'm buying, I'll wait a while. You know, it's not so clever. It's just trying to work out how well it can get those trends. And so what we've developed is algorithmic trading that uses an element of machine learning to decide what type of strategy you want to do and which direction you think price is going. So yes, algorithmic trading does exist and automated trading exists. I see automated trading protects value and saves money. Algorithmic trading has the propensity to create value, but you get more risk because you're taking a view.
I love that. Chris, talk to us about some algo trading strategies for companies that are just getting started with algo trading. And what are the sort of data sets that you need to begin this journey?
So as a beginner, I wouldn't go into some of the fancier algos. I would start to think about some simple rules-based trading, which is a module that we've created as well. So in rules-based trading, you decide how much risk you want to take on. And we've predefined a number of ways of doing that. One of my go-to algos or rules I call the legger, and it's an averaging in process. So many traders might have a PPA with a wind farm, which is based on the average price of all trades in the market, something akin to the market index price that was created in the early 2000s. How do you achieve a price trading that's similar to the average? Well, if you do all of your trade early or all your trade late, you might beat it, you might lose against it. But if you do a little bit often, how can your trading price be that different from the market average? So if there was 400 trades going to happen for midday and I needed to do 10, maybe I'll just do one like an hour from delivery, and then every 6 minutes do another one.
So small clips.
Small clips. And of course, if the market is moving around, just doing small clips is a very clever way of just making sure you get the average. So the legger was developed to get average price, because your trader might be exposed to average price with a PPA. Minimize the risk by averaging in. You might have a very determined price view. So you might do something like a closer that just says, if the market price goes above, sell. Why would you do that? Well, you might have an asset that costs £50 a megawatt hour to generate. And you say, well, I want to make a bit of profit at 55, sell. Now you don't have to sit there watching that market all of the time, you just let it sell. So you have a closer. And then you might say, well, so far you've given me a series of what I call aggressing kind of trades. An aggressing trade means that I'll do my trade now and I'll take someone else's price. But you might want to do what I call an initiation trade, whereby I'm not going to take the market price to bid off for spread. I'm going to put something on the screen and see if someone comes to me. And you can generally make more profits if you do a successful initiation and the market isn't too volatile. So you could come up with something that tracks market value. You'd say, all right, my tracker in my rules, I just want to be second best, or I want to be in the stack in case someone's desperate to trade. You wait for one of those aggressors to come in. So that's a series of kind of simple strategies that you could initiate just to see if you could either minimize your risk, profit take on an asset, or just sit there passively waiting to see if opportunity comes to you.
That is amazing. Great insight, Chris. So, next question. I've started off with basic trading strategies, and I'm a trading company with traders that have been used to going into these trading events with 150, 200 megawatts a trade. It's a paradigm shift, right? It's for me to not be able to trade in one go, to have that sort of a clip format. I mean, the tools really need to bring me on that journey.
Yeah, you definitely need to, but also those traders that had big clips had big assets. They had a 500 megawatt coal power station, and one of the things you learn very quickly about power stations is you can't move them around as much as you think. We say flex used to come from coal. If you had a 500 megawatt coal power station, it would not go below 250 without switching off. So that means as soon as you made a decision to turn it on, you had 250 minimum to sell, but as you turned it up, it got cheaper. So logically, if you wanted to sell 250, you want to sell 500. That's a big clip. So you had this big clip mindset, and therefore you did big trades because otherwise it overcame you. Nowadays, you've got fleets of batteries that are aggregated up into your portfolio. So therefore, you need to be able to do lots of little trades, and that's where automation really helps, because if you've got 48 half hours of the day, you're only going to be liquid for the next 5 half hours, probably, maybe 6, but you're probably going to need to do 20, 30 small trades to average out your position rather than the big hit, and that's where your tools really need to help you.
And so the thinking about your portfolio as volume and price, really, right?
Exactly.
Rather
so
than the
you
asset.
rotate your mindset from I've got volume to at this price, what do I need to do? And you stop looking at your portfolio as kind of discrete lumps, and you just see it as a continuous stream, and you move up and down the gradient. And as you move up and down the gradient with price, you get a resulting megawatts. So that's why I always say you've rotated to kind of a perpendicular view of the traditional 2001 trader.
So what are some of the more advanced trading strategies that you start to see from an algo perspective that successful companies start to venture into?
So one of the ones that I find really interesting is a momentum strategy. So a classic trading strategy might be a mean reversion strategy, i.e. prices away from where they should be, they're going to come back, or it could be the market's going up. If the market's going up, why wouldn't it continue to go up? And so in the momentum strategy that I really like is you can recognize that certain instruments in the short term under certain conditions, if they're going in one direction, is far greater than 50% chance that they continue going in that direction. So if you can recognize the pattern of the ones that have more momentum and mean reversion, then if you inherited a net open position and you recognize that with enough confidence, you could go for a price-based automated strategy. Machine learn may be the gradient from all of the other independent variables and decide, okay, well, I'm a seller, I'm going to wait for it to come up and sell. And if you inherit that kind of strategy, you start beating market. And algos with that kind of learning beat market. I see automation as they trying to get market average, but they haven't got any insight on price. So if they haven't got an insight on price, how can they beat market? So momentum is one of my favorites. You could do that as an aggressor. That's slightly less on the profitability, but it's less risk because it always closes out, so you force close your position. But if you did a momentum initiator where you were trying to sell and you just were trying to move your price up as the market came and get people to take you, you can get some really good percentage P&Ls over the market average.
Incredible, and the people who are sitting in the risk part of the business are feeling a bit nervous when they hear that the traders have gone full on board with algo trading, and we've seen, as history tells us, rogue traders. We've heard about rogue algos. Where's the kill switch? How do you protect the risk and the exposure that comes with algo trading?
Well, for me, the journey of putting an algo into life starts with rigorous backtesting. And I see the relationship between the trading manager and the compliance or risk manager of moving into something of an approval stage. So you're going to have this incredibly clever quant-stroke data scientist, and he's going to come up, or she'll come up with this amazing idea, and they'll say it's going to make millions. Yeah. Now, historically, traders wouldn't be able to prove that. Now, you could say, all right, well, if your strategy is going to make millions, test it on a data set of 2023 and 2024 and tell me how much it would have made. So a rigorous backtesting framework that simulates all of the actual prices and your position you'd have to see what your profit means that you've tested on a lot of data. Previously, you'd do a trader's test, you'd look at them and you say, off you go to the desk, and you don't know whether they're going to be an idiot or sensible. They pass the test, you can't validate, and then they make money. So rogue traders were taking risks without people seeing it and hoping to get profits, and they usually doubled down on a bad position, and then it just got worse and worse, the classic kind of Nick Leeson of Barings Bank. The thing that's different about algo trading is, one, you have to prove it would have made money, great. The second thing is, because we're doing short term, everything's little instruments, so you kind of just incrementally making money or incrementally losing, and it is easy to track. So as long as you're on top of your P&L as it comes in, and it's as expected compared to your back testing. You have a framework. You add in the ability to put kill switches in. We put that in all of our products. You're in. But the final thing that I think is most important is it never used to be possible to understand why a trader didn't trade, because it wasn't there. There was no data. So if they had a long position, i.e. they need to sell and they didn't sell, you had nothing other than anecdotes to know why they didn't sell. However, if you have an algo and it didn't sell, it knows why it didn't sell. So having a compliance ticker that tells you why something didn't happen, I think is coming as important as why you did do something. And that's something you can get out of automation, and I put in my own compliance ticker.
Brilliant. So that explanation is really essential, isn't it? That goes along with it, especially when it's an automated process.
Yeah.
So Chris, as much as short-term power trading and algos are part of any power trading company's portfolio, there are the long-term bets that are being made around providing route-to-market services, power purchase agreements, and power purchase agreements with more ESG, environmental, social responsibility geared company manifestos are driving the reduction in carbonization, and therefore owning up to buying green power, investing in green power, helping bring more green power. What is the sort of portfolio mix that you're seeing, and where is the opportunity with PPA evolving, especially from a corporate perspective?
I think very much in the kind of PPA structure as we go forward. Well, as I kind of left the trading desk a few years ago, I was seeing much more of an appetite for continuous green power. Now, I'm skeptical on certification and greenwashing, especially in the retail world. So you can have a wind farm and it's going to generate when it wants to generate, and then at the end of the year you're going to get, if it did 30 units, you've got 30 certificates, you can trade those, but you'll also get 30 other certificates that are slightly different, and you might be able to retrade them. But what you never really see is the greenness traveling with the megawatt traded to the end user. And the fact that all megawatts are fungible, i.e. exchangeable, means you've got that lack of traceability, but also you don't have continuous green power. And we saw some companies out there, the Googles and like, saying, no, we don't just want to buy a load of certificates at the end of the year. I want to know every hour, every half hour, every quarter of an hour, I'm getting green source. And from that, what you see is more of an international buying set. So if you buy energy from all over the world into your data centers all over the world, you'll actually find when one's overproducing, one's underproducing, you start getting like a law of averages, flattening, so you can become more green. But also if you start investing on on-site batteries, then you can smooth your load, or you have a battery PPA to smooth the way that you're doing your intermittency, you could then self-supply. So I think that we're going to see companies move much more into continuous greenness, a bit more of the origin being more important. But the thing going against them is most markets' central register of the flow of megawatts separates the megawatts from origin, completely fungible. So you have to find ways to get that working. And I don't think certificates have been great for many years.
Understood. Now, trading, especially OTC, over the counter, the more bilateral bespoke trades that we do, come with having to settle the trade. And settlement sometimes can be a difficult process, needing lots of hand-holding. Talk to us a little bit about how has your experience been with settlements, and what are the right sort of systems and architectures and platforms and data sets that help making settlements more streamlined and more automated?
I've never seen settlement as a massive problem, so long as you have a very, very decent ETRM to put your system in. So Igloo, the Brady ETRM, stores the instruments in a way that's very, very sensible. It does PPAs, and at the end of it, you kind of just need to add up the number of megawatts in the volume times the price agreed, and do it in a really efficient manner, and agree how you're going to communicate to your counterpart so that you both get the same numbers. And even if you went to a very structured PPA, I actually think settlement goes wrong when someone writes a contract ambiguously. I don't think it's a system problem, because settlement is the world's biggest spreadsheet, in my opinion. It's it's good to get it right, but you don't put a lot of science in. But when you've got a structured trader creating price points and optionality into a contract, you have to write that in a very specific way so that it can be interpreted by two settlement managers in their ETRM exactly the same way. Then you don't get settlement problems. So I would always say move the settlement problem up to the trader and say, articulate your trade in the contract in the best way so that it can be settled unambiguously.
Brilliant. So I'm going to ask you some rapid fire questions. The first question, Chris, is what is the biggest asset that you've traded?
So when I was head of the trading of EDF, we had the largest single power station in the country, Sizewell B, which was 1,200 megawatts off a single reactor going through 2 turbines. Not as large as, say, Drax with the 6 different coal power stations, but the largest single asset. So 1,200 megawatts was traded, and occasionally it did break, and it was quite an effort to buy that power back.
What is the highest in terms of GBP pound that you have transacted in a single trade?
So this one's an interesting one. So in 2009, the company I worked for was called British Energy, and they had all of the nuclear power stations and a large business portfolio. And we were bought by EDF, and I ran the program called One Portfolio to bring the 2 books together. So I actually had to triangulate the complete British Energy position into EDF, and I did that with my friend Adam one weekend, and we did the first £1 billion electricity trade. Now, it was a 5-year-long shaped trade to back out all forward hedges and retail portfolio, and we pushed some across to Centrica, who were an off-take of that agreement. But yeah, that was a nervy £1 billion.
Wow, that's big numbers. Would you prefer trading in the GB market, in the European market, or with interconnectors? Tell us in less than a sentence why.
I prefer GB because you're allowed to be out of balance, and if you're wrong, you get financially penalised rather than you're told to follow rules.
Do you see traders of the future being really good VBA scripters or Python developers?
100% Python developers. I even see traders moving away from being like great communicators, engineers, to being mathematicians and data scientists. And I have 2 defined personas on my desk. I have the data science analyst and the data science trader. And they're almost the same, but one's a bit more live than the other. But traders will be data scientists in the end.
Brilliant. Are you learning Python?
I've written my own battery optimizer that I use quite heavily in my consultancy, so I have some Python skills, and I try learning with my 13-year-old daughter.
Brilliant. How many screens have you used, the maximum number of screens you've used on your time as a power trader?
So back around, I think around 2005-06, EDF were running the largest generation portfolio. We had a number of assets, but we also did trading services for the Nuclear Decommissioning Authority, which was slightly segregated. So I had circa 90 screens for a team of 3 traders, but we needed to have every asset separately managed, and we had to have, so you had to have the asset trading like schedule screens, as well as the position screens, as well as our trading services. So we very much moved to a dark theme on the desk, otherwise all of the traders would have huge tans from the white kind of screens shining on them all day.
Would you put your money on Gen AI in power trading?
Well, I know yourselves at Avanade are very much into Gen AI, so you'll want to hear a yes answer, so definitely. As I explained with some of our algos, we are using a form of AI, but we're using machine learning, a very kind of mathematical form of AI, to make sure that that big data problem becomes a very simple buy early or sell late type thing. So definitely going to be in there because there's too much data for the human brain to get those trends nowadays.
Brilliant. Well, Chris, it would be really important for me to ask, and it would be a wasted opportunity if I didn't ask this question, is what are the big 3 trends you see within the power trading markets emerge in the very near to the long-term future? And if you could associate with that some technology trends, we would love to hear that from you.
Sure. I think my first one I would think about would be the price direction algo. I think there's a lot of rules and a lot of automation out, but I think more and more we're going to see the algos being written to make decisions rather than follow a script. So the move from automation to algorithmic with machine learning taking direction, that's going to be quite a big change. A lot more people get involved in that, but that also creates a skill set change, which is why I say the trader will be a data scientist from history, because I think a lot of the trading will be done automated. And I always say it's no longer click to trade, it's script to trade. So
love that.
That's one thing. The next thing I really do see is I think the battery market's going to recover. We've had a very bad kind of late 23, poor early 24, but ultimately...
And what's been the reason for the poor market turnout?
Well, we've seen saturation in the ancillary services, but we've also seen a mild winter with a very mild February go through 24. So we saw markets going from what traditionally be over £100 a kilowatt annualized down to 60 or less, depending on how well you were trading your battery. But renewables continue to be built. We've got a new government that's very much into renewables. As renewables get built, batteries are going to be needed, and we know that National Grid and Ofgem are clever enough to work out we need the products there to get the batteries in so that we can have the intermittency from renewables to balance the system. So I see a recovery, and I think we had a dip in Q1, Q2 of 24, and we've seen recovery. And that kind of brings me on to my third point. Traditionally, everyone thinks electricity is interesting in winter. Very cold, everyone's turning the lights on, but we're seeing a shift into summer. Now, this actually happened back in 2003, where we had really, really hot weather. I don't know if you remember, but the nuclear power stations in France were being shut down because the concrete was getting too hot. Huge temperature issues with air conditioning. And actually, we're starting to see definitely the GB market value for batteries shift into a model where I think you make more money in summer when there's too much uncertainty over intermittency and not a lot of demand, compared to winter where it's a bit predictable, and batteries and short-term flexible assets make money out of uncertainty. You get more uncertainty in summer now than you do in winter.
I'm so glad I asked you that question, because that sort of insight is not available elsewhere, right? It comes with experience. It comes with the experience of being in the industry for so long, having seen and witnessed all of these trends. Chris, final one. Plug in something. Happy for you to talk about your ventures and what you're up to, and plug anything away.
So as Managing Director of Brady Technologies Short-Term Power, we've got some fantastic products. We've got a market-leading data manager solution, so keep all your time series out of your ETRM, put it into a data manager. We have the widest ranging scheduler across Europe. You could move power around Europe in all of the marketing countries that are liquid enough. We've got the widest one. We've got over 30 connectors to TSO with PowerDesk Scheduler. We've got the most innovative trading dashboard in PowerDesk, which means get rid of the spreadsheet. You've got this amazing thing that allows you to trade live from your position report, allows you to get your asset updates instantaneously. And finally, with PowerDesk Edge, we've not created an algorithmic solution with a UX. It's a Python scripting product. So instead of having like a little menu, we write you Python subclasses, and the data science becomes a trader because they write in Python. Completely innovative. Customers are loving it, really signing up for our backtesting service. So those are our key products at the moment.
Brilliant. Well, Chris, thank you so much for joining us in the studio today. It was a pleasure having you, and we'd love to have you back and hear your stories, hopefully in the next few years. And I'd encourage everyone to go and follow Chris on LinkedIn and go and read his thought leadership white papers as well. And thank you, Chris. Really appreciate that.
Thank you. Cheers again.